Hi, Shae Russell here on behalf of mining.com.au, and joining me today is Dan Porter. Now, Dan Porter is the portfolio asset manager of hang on, I'm actually going to refer to my notes for this one, the Pure Resources Fund by Pure Asset Management. Dan, how are you today?
I'm good, Shae, and thanks for the lovely introduction.
Yes, well, I did have to refer to my notes. I was actually hoping I wouldn't have to, but I realized that it was going to take too many takes
Wasn't gonna,
otherwise.
yeah, there's a bit of jargon in there.
Few P's in there
Yeah,
that I needed to get out.
that's right. That's right.
Now, Dan, you're joining me today in ahead of the upcoming Minds and Money Connect Melbourne conference, which is being held on June 14 and 15. And I'm thrilled to have you on board. I
Yeah,
thoroughly enjoyed our panel discussion yesterday. So I look
yeah.
forward to your panelist contributions at the June conference this year. But I want to kick off today with something relating to the small cap sector, and that
Hmm.
is funding. Now,
Yeah.
obviously, in the last couple of years, and I've asked these questions a couple of times, and the reason why, there's a slight tangent here. The reason why I
Hmm.
do keep asking this question is everybody's got a different opinion. Now, we know
Hmm.
that the small cap sector in mining has actually took advantage of certain policies over the past couple of years, and they used it to become well funded. Now,
Yeah.
tell me, has the tap run dry? Are we likely to see these companies be able to eke any more capital out of the markets to fund some of their
Hmm.
exploration programs?
Yeah, look, I think the last couple of years there has been a lot of money raised on equity capital markets for the small mining companies, whether that's for exploration or project development. There's been access to capital that's been reasonably strong, and we've had, particularly through the end of 2020 and into 2021, had some really good tailwinds from commodity prices, which definitely helps. Since the middle of last year, though, commodity prices have been a bit of a mixed bag. We had a really big fall away in June, July. They recovered slightly, but sentiment was pretty negative towards the sector, I would say, until sort of December last year. We had a bit of a respite over the Christmas period, but certainly what happened then was the fact that equity markets had been closed for 2 quarters meant that the small cap miners were really pressured. So I think I came back to work in January of this year, and I've never had so many inbound inquiries on my Christmas holiday. I would be the only person in the world whose wife said, "I'm buying you a burner phone for the next Christmas holiday." But it was obvious, coming back into January, there's a huge working capital squeeze, and the balance sheets were stretched to their limit. I think, though, what's happened is I expected a few more equity raisings to take place in April or March, April. There wasn't that many that took place in that time. It was pretty quiet in the small resources end. There's been a couple more in the first week of May, but all in all, I'd say that the small mining sector is really, they're pedaling pretty hard at the moment to stay upright. So I think there's a big demand for capital and cash, but I don't think the market sentiment is quite there yet to deliver those raisings.
Dan, I think this is an excellent time to give people a sneak peek of what you do. Now, I've
Mm,
called you sort of a contrarian indicator in the markets
yeah,
before.
yeah,
Could I get you to explain to everybody what your firm does and
yeah,
what companies approaching your business for funding, what that actually might mean of where they are in the business cycle?
yeah, absolutely. So we are a dedicated hybrid debt fund. So we're a bit different to your average equity fund or even royalty fund. So what we have done effectively is taken a convertible note and changed it and put it on its head, and made it much more user friendly, both for investors and for companies themselves. So we've split out that convertible note into two core constituents: equity on one side, straight debt on the other. And it works really well for the companies that we are investing in, and for the smaller end of the market more broadly. What it means is that companies are generally coming to us when their share price is, in the toilet, effectively. They might have a big project that they need to fund. The market knows that they have a big project that they need to fund, and their share price becomes pressured because they can't raise. So they will come to us then for a far less dilutive piece of capital. And the benefit for the companies that we're working with is the option value that we price is always out of the money. So we are therefore on the journey with these companies. We want the equity price to go up. We're not a conventional sort of, or predatory lender. We are working with companies. We want to see them grow. So what it means, though, is that we are very much a contrarian fund. When times are a little bit harder, certainly companies use us. When times are easier or the commodity price is in your back pocket and you've got some good tailwinds, companies are more likely to use equity markets.
So broadly speaking, as you said, your phone was ringing hot over the Christmas break.
Yeah.
What type of commodity companies are approaching you right now? Because obviously gold's quite hot at the moment, but it wasn't for last year. We've got oil and gas companies that are gaining some interest. So where across the sector, what sort of commodities are you seeing come to you? Commodity companies are you seeing come to you?
Yeah, look, I think last year was definitely a tale of two halves. Earlier in the year, you saw energy companies coming to us. In the back half of the year, you saw copper and gold. So I think that was, really, especially on the gold side, paved the way for what we're seeing now. The gold price had a good rally from the end of last year up into now. But we are still seeing a lot of demand and interest out of the gold space, even with the prices where they are, because cost bases have moved so far to the north and balance sheets are stretched. So what is interesting at the moment, Shae, is I would say that we don't have a particular commodity mix that's coming towards us. I would say it's every commodity mix that's coming towards us. And that's because of inflation.
That's quite interesting. Okay, good to know. I'm going to move on a little bit to an article that mining.com.au recently commented on, and that was some PwC research that noted that transformational deals are back. Now, obviously, what you were just talking about before was referencing the small cap sector, but PwC noted that Australia and Canada were a hive of activity for merger and acquisition during 2002, and I believe the total value of mining deals was something like 69%. Broadly speaking, equating nearly $16 billion, which is a lot of money. Now, generally, this is happening at the higher end of town. Are we likely to see any of this M&A filter through to the small caps? So as you've just pointed out, many of them desperately need some funds.
Yeah, I think we will. If you think about the size of that M&A pool, the $16 billion figure that you mentioned, it's usually over a few deals. They tend to be quite large, and might be 7 or 8 deals that make up that mix. 4 or 5 of them are probably 90% of that, and then you get a few more below that. But look, I think the one thing that hasn't changed and has been a building trend and a rapidly growing trend, I would say, in the last 2 or 3 years, has been the supply and demand imbalance. Now, you could say that for almost every commodity, there's a serious supply and demand imbalance. There are chops and changes to that, but what the big guys know is that they will need a lot more product over the years to fulfill what's coming down the pipe in terms of demand, whether it's battery metals, whether it's bulks. There's just not been enough investment going into new projects. And that really happened at the end of the last cycle, where big mining companies, we saw a lot of board and management changes, and they focused really on capital and shareholder returns. And that money wasn't put back into the ground to the same extent as it was. And now we're caught in this situation where if you look at the London Metals Exchange, it's a pretty horrifying graph. And if you think about the forecast that we have for any major building program or green energy trends or electric cars, it's hard to see where the materials come from to fulfill all of those forecasts.
All right, so while we're looking at companies that are struggling to raise funds in this market, are there any particular small cap juniors in this sector that are looking particularly cheap to you? Now, the caveat here is I am yet to meet an explorer that doesn't think their share price is cheap. But with your analytical lens, tell me, what sectors do you think are unfairly undervalued at the moment?
Yeah, that's a very good question, and I think a very good point that you make as well. Resources is one of those things where it needs a bit of optimism to get things done, but then at the same time, everyone thinks they're sitting on $1 billion project.
Yes.
So there's always a disconnect, but that's our job to filter those out. I would say with policy changes that we've seen, particularly in the domestic landscape at the moment, the energy sector is looking particularly undervalued. And undervalued on a very near-term basis as well. If you look at the mix of energy and requirements going into winter this year, I think with different supply coming out of the market and policy changes in terms of price caps, I think we're going to have a really strong run in energy stocks in the second half of the year, or let's call it quarter 2 and 3, as the energy mix changes over winter. I think that's definitely one to keep an eye on. I think in the gold space, we're going to see a lot more cap raises coming through now. I think the tailwinds of the price are strong enough to get investors back and looking at the sector in a more incisive way than they probably have previously. Now, you wouldn't know that we've got $2,000 or $3,000 Aussie gold at the moment from the way equity markets operating. It's almost like we've got $1,000 gold. Now that's, and cost bases have moved up rapidly, right? For a lot of these smaller producers, particularly, it's almost a profitless commodity price boom. And there's still a lot of companies that I think are pressured and will come back to the market, and some that will disappear. But others that certainly provide good takeover targets, and there's certainly companies that are taking advantage of the space at the moment. Not all of them necessarily are the big caps. There are some good small caps out there that are making a lot of money, that have some neighbours that are looking pretty ripe for the picking too.
Now, I'm going to talk about critical minerals. Now, this is a subject that I don't think gets enough attention. I know this is something you and I have actually talked about in the past. Now, according to the International Energy Association, they've got 50 critical minerals on that list. And I do believe there is some difference from country to country. Now, they're boring ones like aluminium, manganese, tin, and nickel, but then there's some exotic ones on there as well that I'm not sure I'm going to embarrass myself by trying to pronounce in a hurry. Tell me, when it comes to critical minerals, do you have a particular area that you think need more attention out of this 50 list? Because 50s, that's nearly half the periodic table. Like, that's quite a broad list to say that these are so urgent that we need these minerals in order to, fulfill some of these infrastructure goals that we've got. Yeah. So is there a sort of a smaller one in there, a smaller one or two elements in there that perhaps markets could be looking at?
Yeah, absolutely. I think, speaking more broadly of critical minerals, I think the reason the market is or has found it historically so hard to invest in them is their commodity prices are very opaque. So there's not generally traded markets where you can look at it and get, like an iron ore market, for example, and say, look, here's the spot price at this exact minute. It just doesn't happen in some of those markets like tungsten, antimony, kaolin, even for that matter. They're very opaque, so you can't hedge. So bigger banks won't look at them. And even some of the more resources-focused lenders out there find it difficult because you can't get that pricing signal. So it doesn't mean that they're not required. They're often used in areas that you would never even think of, but we use them every day, and that's why they're on the critical minerals list. There is a big supply and demand imbalance out there. Now, Australia has a lot of critical minerals. The big challenge for financing them is to find lenders and equity investors who understand the market, who will take the time to look at it in more detail. Because sometimes when you look at these markets, it's really eye-opening to see what is happening, and particularly with changing sources of supply. And I mean geographic supply. The Western world is trying to bring about more of their own supply, bring it out of China and be a bit more self-reliant. And that is going to drive a lot of investment. There's a lot of demand from Europe and North America and Australian critical minerals as well. So I suspect that we'll see some pretty left field types of financing coming through, your trade type organizations, Austrade, that type of thing. But particularly, the Germans and the French have been very proactive in that area in terms of finding projects that they need, because they just don't have them. So Australia is pretty uniquely positioned in that regard. We've got, pretty decent supplies of tungsten, even cobalt, which is a critical mineral, even though it's, generally considered an EV type material. But there'll be a lot of investment required in that space. And I think for astute investors, a lot of money to be made as well.
So, as you just mentioned, that there's going to have to be some unconventional funding types to access some of these minerals or to get some of these projects off the ground. How does the ordinary retail investor obtain exposure to some of these more unique investments, I guess?
Yeah, very good question. In terms of the Australian market, there's a lot of companies out there who are listed who have critical minerals, but it's maybe not their main project. So it's hard to get that look through. There's a few out there that have genuine critical minerals projects, but it might be one asset. And then people look at that and think, oh, it's a bit risky because you've got one asset. Now, I would suspect that they're the ones that will merge and take each other over and that type of thing. So you might have 2 or 3 assets in one particular commodity set. Now, it is a sector, I should say, that in some respects is in its infancy a little bit, because a lot of these projects would have been developed by bigger mining companies previously rather than smaller mining companies on a standalone basis, or they just would have been produced in South America or in China, where there's a lot of them as well. So I think just the changing nature of that market means that investors have an opportunity now to get in at the ground floor. And if you look at some of the critical mineral prices, they've been far more stable than anything else in the market out there. And the share prices have reflected that as well. You know, where we have seen pretty extreme volatility in the small end of the resources market in the past 6 to 9 months, those share prices have proved pretty resilient. So it's a pretty good opportunity for investors there.
All right, we are going to close out today's conversation with our 60 seconds or less answer. I will probably take a lot longer than 60 seconds to ask the question, but the goal is to try and get you to basically sum up your investing thesis in a short space of time. Now, this time around, I actually do have my phone and I will be setting a stopwatch. Let me get that ready to go. Now, let's think. Dan, out of all of the things we've talked about today, obviously critical minerals being one, but obviously there's other companies that have come knocking on your firm's door looking for funding. Tell me, where do you think is the biggest opportunity in relation to a commodity for investors right now? And timer is live.
The biggest opportunity in commodities space at the moment, I think, is anything to do with energy. And the reason I say that is because there's been a lot of politics involved, and when politics get involved in something, it generally goes pretty bad. And I think globally we've seen that happen. And I think that presents an opportunity for all investors, to exploit that situation and to make some decent returns out of it. Now, when I say energy, I'm talking about all forms of energy, because we are short all forms of energy. It doesn't matter what it is. Whether it's battery metals, EVs, that type of thing. We just don't have enough product in the world. And you're not talking about Australia or New Zealand or Queensland or New South Wales on its own. It's literally a global shortage of every type of energy commodity, because there has not been enough investment in the past 15 years because of policy uncertainty and political uncertainty. But in the next few years, I think there's going to be areas where we've realized, whoops, we made a mistake here, or we've gone too far there, and you'll be able to exploit those. So a basket of all energy, I think, is a great way for investors to make money in the next 2 to 3 years.
So it was a little over 1 minute, but it was an excellent answer, so there'll be no repercussions.
Thank you. Thank you.
All right, Dan, I'm not allowed to have favorites in this job, but I always do thoroughly enjoy sharing your insights with people. You are an incredible analyst to listen to, and I really hope people do come down to the Minds and Money conference, which is being held in June in Melbourne from 14th to 15th, and it'll be great to hear you expand on some of your thoughts there. Dan, thank you once again for being here.
As always, Shae, an absolute pleasure to catch up and great to chat to everyone as well.
Don't forget, if you want to hear more from Dan Porter or some of the other amazing guests that I've had here on behalf of mining.com.au, make sure you click the link below to attend the Minds and Money in Connect Melbourne conference on June 14 and 15. I hope to see you there.